welcome to this Maine Small Business Development Center's webinar called Where's the Money Hiding, or Finding Funding. I'm Ann McAlhany, and I'm pleased to be presenting this with my colleague, Chris O'Brien. We're just a couple of comments about our program. We are, again, the Maine Small Business Development Center, hosted at different agencies around the state. Chris and I so happen are hosted by CEI, which you'll see in our email address. But funding comes from various sources, including the SBA, the Small Business Administration. And we do function under some federal guidelines, even though we are not state or federal employees. Next, Chris.
Everything's locked up.
Uh-oh. Just when we thought we had the technology conquered.
We thought we had it down, and now my buttons are not working.
Okay, and I wouldn't have control over that either. Well, just while you're working on that, Chris, I can at least say just a couple of housekeeping details. This webinar is being recorded, which you, I think, signed off on when you came into the room. So if you would keep your cell phone mute, but I think everyone is, we will we'll certainly take questions. Certainly feel free to put questions in the chat. We'll try to answer general questions as we go along if they seem appropriate. But because we've said we had a 30-minute time frame to give everyone a chance to get to the content, we'll certainly then, as we've said, we would stay later after that 30-minute mark, and we can take more specific questions at that point. Are you back, Chris?
I am. Yes, here we go. We're in business.
All righty. Thank you, everyone, for your patience. Go on, Chris.
All right. We've covered that. So I'll start with me. I am Chris O'Brien. I am the SBDC business advisor based in Waterville. My office is in the Mid-Maine Chamber of Commerce, and that is where I see people, but also available to meet with people by Zoom, as is Ann.
Yeah, and like Chris says, I actually am physically in the Bangor office. I'm assigned to the Bangor office, and today I'm physically in the Bangor office looking at One Cumberland Place, if people know downtown Bangor, looking out of you can see the rooftop of the library and the federal building. But also, probably most of my work is on Zoom, although we are back meeting meeting people in person as well. I, if you will, have the distinction of being the most senior advisor in the state, which means I've been around for a while and I've heard lots of stories and enjoyed working with a number of different people. I would say I feel like my job is to help take business plans and visions and make them into an action plan. I've got background in food and inventory management, and now let's find out about you, because that's really what we're here for. There's a little poll here.
We'll just give you a couple seconds to answer, and then we'll see what we've got. All right, fantastic. So it looks like close to 2/3 of this group already owns a business, about 60-40. And then we have some that are exploring those entrepreneurial opportunities. So we'll try to speak to both of you, and you can put your questions in the chat. And at the end, we'll try to cover all of that, but also be mindful of your time today. You can see in the end, we had 62% of existing business owners and 38% are on their way. So we will stop sharing that, and then we'll move on to the next slide, which now isn't working. All right, I apologize. We seem to be having, oh, here we go.
There it went. I think it was wanting to get rid of the poll, maybe.
That's it. All right. So
the poll didn't work. I think we didn't share the poll out enough. So anyway, there were just the three categories. As Chris said, about 1/3 of the participants right now are aspiring business owners, and 2/3 are existing business owners. So thank you. That's helpful data for us. Just to give you a quick overview of what we plan to talk about. We'll talk about sources of funding. Money comes from different places, and and that matters. We'll also talk about a minute about fit, because one size does not fit all in the funding world. And then we'll touch on some preparation, particularly around what we see the most often, which is traditional lending. And will also apply to others. And then at the end, we'll send out a couple of short tools and small tools or resources. And then, as we said, take questions afterwards. So we lost the PowerPoint.
Yeah, we're still having some technical issues with the slide, so I apologize for that.
But I'll keep chatting. So sources, right? There you go. Money can come from different places. One place is money comes from us. And then there's this other source of, well, duh, money comes from somewhere else. It seems pretty basic, but that really is true. And again, it matters, right, Chris?
Absolutely. So when we say money from us, we mean right out of your pocket, from your bank account, your savings, someone else. That could be
I don't
family.
see the slides, Chris. There we got it.
There we go. So the piggy bank, that's your money. And then we also have someone else. So I forget all our little icons here, but those could be traditional lenders. That could be your bank. That could be from crowdsourcing, a GoFundMe campaign to get your business going. It could also be from a grant. It could be from an angel investor. Those are a little bit unusual, but those do happen.
Right. And just to add to that, Chris, is back up a second. There you go. Perfect. So that first one is, it can come from us. It can come from our network, those family friends, we call it. There's that traditional lender, but remember, the traditional lenders are regulated. They have federal regulations that guide them. So they have certain restrictions in a box they work in. Then there's those, as we said, the alternative lenders, and you'll hear names within our state from CEI, which is an alternative or sub-debt lender. There's also certain like AvCog or KVCog, or what is it, CPG Cog in Southern Maine. So some of the cogs,
Southern Maine Finance Agency. There's actually quite a few, and people don't know as much about them, but they have a pretty important space in the lending realm. And we can talk about that because we will get into what your traditional lender can and can't do for you.
Exactly. And then there's those, as we said, the grants, whether it's crowdsourcing. So that's basically money you don't have to pay back, I would call it. So crowdsourcing, where you have a certain agreement maybe to offer some sort of rewards or prizes to the grants that are in our world. People talk about community development block grants that have certain income requirements. Some grants have regional requirements. There's technical grants for certain types of disability. There's the VR grants or VR support. So there are different ones out there. But then there's some things where you should not go, right, Chris?
So there are some sources of funding that are not really beneficial to a business. And I would say these opportunities are presented more to existing business owners, but sometimes a startup. And I'm going to address probably the two biggest temptations that you might want to think twice before pursuing. The first and probably the most common is credit card debt. A lot of people can find the loan application process daunting, particularly the first time they do it. And it's easy to say, well, I've got some plastic in my wallet and I won't have to wait for a loan decision and I won't have to talk to anybody about my credit and I can just move forward. The cost of doing business that way is extremely high. And that needs to really be considered before you make that leap. So there may be instances where it makes sense for you. It may be a one-time purchase that you know you're going to be able to pay off in 3 months, and you have a 0% for 1 year. And so maybe that's an okay way to do it. But when you're talking about 15 to 30% interest rate on a credit card, and you're using it haphazardly, that's going to snowball very quickly and create a financial drain on your business.
My personal experience has been that 0% interest rate ends well before you're ready for it to. Even if you think it's only 3 or 4 months, you can pay it off. I find that other things can creep in, and it can be a problem. So just have a plan.
12 months can get away from you before you know it. And the second type of lender that I want to mention, which isn't as common, but I think is much more threatening to your business, is a lender that we refer to as a hard money lender. And I think the analogy, if you haven't come across that yet, would be the equivalent of a payday lender for a personal use. And so how that works is a loan is made to you, and it can be presented as very attractive because they can get the funding out to you very quickly. So we'll have the funds in your account tomorrow. You can sign everything electronically. Sounds great. But the trap of that is the interest rates can be in excess of 300%. And they will draft your loan payment daily by ACH. And my background before I was with the SBDC was as a commercial lender. So I would come up against this quite often. And I can say with 100% certainty that every business that took that route was not able to remain in business. It's very predatory. Unfortunately, it is legal. And it happens. There's a couple of lenders here in Maine. The most common one is called On Deck. And they're very aggressive. They make it sound really great. And they kind of suck you in. And the next thing you know, you have a large sum of money being drafted out of your checking account every single day. And if you were borrowing money because you were struggling with cash, you can imagine that that doesn't go very far. So I really caution any of you, if you're not in business yet, tuck that in the back of your mind. And if you're already in business, really chase down any other option before you even look at that. And even if you look at that, I would dismiss it very quickly. It's dangerous, and it can be fatal to your business.
And just to make sure folks know what ACH is that automated clearinghouse? But yes, it means when you sign all those documents and all that fine print that you might really not want to read because it's a lot of it, but you should read it, you've really given the permission to take money out every single day. And that money comes out at the top. So then whatever's left is what you have to pay the rest of your bills with. And as Chris said, if you're already short on cash, then it can sometimes be the final blow to tip you over the edge. So beware.
So you need to find the right fit for your needs. So we like to say that the first rule is she who has the money makes the rules. And so that what we're trying to say there is if you're going to a bank has certain requirements. And as Anne mentioned earlier in the session, banks are regulated by the FDIC, or credit unions have a different federal oversight, but they have specific rules. And so when they have a policy, it's pretty rigid because they are being audited by the government. And so typically those rules include things like, what does your credit score need to be? How much equity do you need to invest? What percentage of the loan? So if you need $100,000, many times the bank will say, we can only lend you 75 to 80%. So you have to understand what their requirements are and see if it's going to fit with what you need. And if it doesn't, there's certainly going to be other options. I would encourage anybody to not just make one swipe and when you strike out, give up. A lot of times there's some creativity required, but we need to make sure that the fit is right. So for example, with grants that Anne talked about a few minutes ago, all grant programs are targeted to a particular group, population, geographical area. There's a number of requirements, but it has to fit. And so for your business seeking out financing, you want to make sure that where you get the money fits how you need to use the money and your ability to pay it back.
And right, Chris, I mean, to some extent, any kind of application to others for money is a sales pitch, right? You need to understand what they need as well as what you need and make sure that those two match or those two fit. And as Chris was mentioning, with what we think of as traditional lenders, the banks, and then some of the sub-debt lenders will look at some of the similar, the alternative lenders will look at some similar factors. But certainly for the traditional banks, they're, remember, we don't make the rules, the bank makes the rules. It's because they're regulated. They're basically loaning, banks are really loaning out the money that's in, that you and I have put in our checking and savings accounts, is what they're re-lending. So they have a fiduciary responsibility, a big word that says, they got responsibility to be careful and conservative. Therefore, risk mitigation or not taking chances is one of their primary concerns. And the ways they look at that often are what we think of as the C's of credit. I've seen 3, 5, 7 C's, but you'll see on the sheet, and we can send it out so you can see it better, are things like cash in, cash out, and credit score. If you need money, lenders typically won't loan you the whole thing. Let's say I need $10,000, $100,000, whatever the project is, all those uses of funds that what I need, the bank's typically not going to lend it all, because they'll say, if you don't have some of your money, we're not certainly going to put all of it in there for you. Contribute all of it. Cash out just means that you need a plan that makes sense. We usually look at that through cash flow projections. It could be a whole nother workshop, but putting on a piece of paper, money comes in, why and when, and then money goes out. You have expenses in a business. Is there enough money left over at the end of the day, at the end of the year, to pay the bills? And remember, this is the bank. They want to know that you can pay the debt, that you can make your loan payments. Banks also look at credit score. They use that as one way of how you've paid your bills in the past. For them, is indicative of how you might pay your bills in the future. So just be aware of that. Again, we don't make the rules, but we can help you navigate where you are and how you might best fit with some of these things. And some of the other quick ones were collateral. Do you have something to offer the bank? Like if you get a loan on your car, then your car is the collateral. That means if you don't pay the loan, they'll come take your car back. Same thing with a house loan. Your house is the collateral for the loan. And then other things like capacity. What's your ability to operate this business can be important. And is there a plan B or a contingency? If something shifts and doesn't go the way you think it will. And then go ahead.
Important to add with risk. Most lenders are going to tell you that a startup is a bigger risk than an existing business. So for those of you that already own your business, when you go to the bank to buy a new piece of equipment, you need money to purchase inventory or something else. When you've already been operating, you are able to say, here's my tax return, here's my history, here's what I can tell you about how I will be able to pay this back. When you are starting a business, you are going in with assumptions and a business plan. And that's one of the things that we work with people on, is to help prepare that and help you go in and be prepared and make a good case. But you startups are a greater risk to the bank because there's no history. They're simply relying on your projections and assumptions. And so that very beginning piece, as you go to get your startup money for your business, being able to make a case for how much you need and how you can pay it back is going to be critical in getting them to take the risk. And I will say for startups, some food for thought is, if you go in and a lender says, well, we want you to put some money down, we want you to pledge some collateral. Sometimes people that have equity in their homes are willing to give a second mortgage on their home. That's probably one of the more common ways to get sufficient collateral. And when a person says to their lender, oh, I'm not going to take a risk and pledge my house, the response is going to be, then why would we take a risk on you? So you have to be really aware of how much risk that you're asking them to take, and understand that they have tools available to them to offset some of that risk. And that's another whole seminar, I think. But they do have programs, guarantee programs, that help protect them. But again, a lot easier and straightforward for you existing business owners than for those that are starting up.
Thanks, Chris. Oh, great points. And as she said, but then that means it's really important what you put together and what you present to the bank. Because if you do your preparation, then you can look better from the beginning. And again, this applies to loan packages or to loan applications, but again, it also applies to certain grants, because you're also making a proposal and you need to understand what either the lender or the grantor needs, so that you can make sure you're answering their questions. Certainly for a loan package, make sure you at least have completed it, right? If you send in something that's sort of sloppy or halfway done just because you want to get your foot in the door, you probably haven't speeded up the process and helped you. As Chris said, it's that telling, particularly for startups, that business plan is so important, because you want to address all of those C's of credit that the lender will have. Well, I'm a startup, but here's why I'm not risky. I've already been doing this as a side gig, or I've got experience in this business, or I've already got 3 contracts to do what I want to be selling. So how can you help the lender feel more comfortable about what you're doing? Also, as we mentioned, there's the cash flow projections. To draw a picture, draw it in numbers. This shows a lender, I've got this amount of revenue coming in each month across the calendar year, but here's what's going out, and here's what my projections are that I'll have left over. But always remembering that those cash flow projections, especially for startups, are only as good as the assumptions that back them up. But similarly, for anybody who's an existing business that's thinking about growing or applying for a loan, you've got some great historical information, but you do the same thing. You'd write in your business plan, here's why this is a good opportunity for me. I'm already busting at the seams. If I could add this one piece of equipment, I could do this amount, or I could cut my cost. But to paint that picture for the lender why this is really a good idea and not risky. Same thing with the cash flow projections. You can say, well, here's what I'm already doing. Here's the projected extra income, but here's the extra expense for another person and some more materials. But that more than benefits with the income that I project it will come in. So those pieces are really important to put together to paint a picture to a lender of any sort, or again, to a grant funder also wants to understand your story and why it has potential and won't be risky. There's another sheet that tends to go with this, regardless of who the lender is. Would be a PFS, which is a shorthand for personal financial statement. And I bet you've seen some of these in the past, Chris, right?
So this is, if you think of a business has a balance sheet, the personal financial statement is essentially your personal balance sheet. And this is a self-reporting form. So you enter information based on your knowledge. So you can see, and we'll send all of this out to you so it'll be a little clearer. You're going to report your assets and your liabilities. So for example, they want to know how much money you have in the bank. You're going to list that, the value of your home, the value of your vehicles, all of those things. And then you're going to list your liabilities. So you're going to have your home and the value of the home on one side, but the balance of your mortgage is the liability. Then the next part of that is going to be your income and your expenses. So any household income that you have, so that's going to be your wages, your salaries, if you own rental property. There's a number of sources you could have for income that you're going to list. And then any liabilities, things that you pay, you're going to put an estimate of what your household expenses are every month, because they're going to use this to see a couple of things. how this fits in with what you're doing with your business to make sure that you are going to make enough money and bring home what you need to support what's on your personal financial statement. The other thing, and this is me coming as a former lender, that I would caution you about, because I've seen it too many times, people are inclined to overstate their assets and understate their liabilities. But please understand that what you list in your liabilities is going to be compared to what's on your credit report. So if you say, well, I only owe $1,000 on credit cards, but your credit report says you owe 5,000, you're going to have some splaining to do when it comes to light. And the same thing on your assets. You know, your house, you could say it's worth $1 million. But if the lender looks at the tax card for the city that you live in and sees a tax assessed value of 300,000, even though the tax assessment doesn't always equal the market value, when there's a huge discrepancy, it's a red flag. So when you're reporting your cash on hand, keep in mind the lender can ask you to show bank statements to show what you have to back that number up. So even though it's self-reporting, it's really important to be honest and accurate on this form. And once you have one, you know, keep a copy of it, because you can just update that as you go. And this is the second page of it, but it is a very important part, because while they're going to look at your business cash flow, they're going to add in your personal, and that's called a global cash flow, because most lenders are going to require that when you borrow their money, that you sign a personal guarantee saying, I will pay this debt if my business doesn't. And so they really need to know what you have to back that promise up. Ann, do you want to add anything to that?
No, thanks, Chris. That was great. And just to remind people, the example we chose is an SBA form, a Small Business Administration form, because it's generic. And if you filled it out, most lenders would take it. You could always say, see attached if you applying to a different lender. So it gives you a chance to do sort of this homework ahead of time. But to remember that many lending applications have their own. But again, this is a great place to collect the information in a way that makes sense. Now I know we're right at the end of time. One more slide, Chris. Just a comment, we alluded to it earlier and we've touched in and out on it, but for those non-traditional, not bank sources of lending, eligibility and fit are huge. Funding cycle is more important than people think. Sometimes grants open up at a certain period of time, and maybe it just doesn't work for the cycle of the business that you're in. Don't forget that free money often does have its own strings attached. Many grants have reporting requirements, so don't underestimate those and be aware of any tax implications. I don't know, we're a couple minutes over, so there's one more slide just to say, to confirm, we'll send out a copy of those that sees a credit chart so you can see it with a little bit better, bigger letters, in a copy of this PFS or personal financial statement. So again, you can see what's on it and how you might work on filling in the boxes.
And we are here to help you. There are 14 business advisors across the state of Maine. As Ann mentioned at the beginning, she and I are 2 of 6 that work at CEI. The University of Southern Maine has advisors that work largely with people in the southern part of the state, as well as Androscoggin Valley Council of Governments, Northern Maine Development. We're all a team. We meet every other week by Zoom. So we're all connected in that regard. But if you visit our website, mainesbdc.org, and are interested in getting business advising, there is a button in the upper right corner of that screen. You click Request Advising. That sends you into our system, and you have the option of either selecting an advisor if perhaps someone's referred you to somebody, or if you don't select anybody, you'll be assigned to the advisor that is geographically closest to you. So we are here. Ann and I are happy to respond to emails if you just have some questions to follow up on today's session, or if you would like to start advising, please check out our website.
So Thank you. And now we can jump. There's a few questions I see are coming into the chat box. But this does conclude the primary portion of our presentation, the content piece. So if somebody has to get back to lunch or something, we thank you for your patience and your attention. Let's see. We can look at some of the questions and feel free to put them in the chat or go off mute and you can just ask. One,
steps for startup to look more attractive for funding. You know, the business plan is a really big key to this. And, you know, and I think we've mentioned that a couple of times throughout this, having that business plan and supporting what you project with really solid assumptions is going to make you look good. The other thing that I recommend to my clients that I think is important is before you go into a lender to talk about a business loan, really understand what your personal financial position is. Know what your credit score is. There are options to obtain your credit score. Many credit cards and banks offer that as a service now for free so that you know what your credit score is. You can look at your report and make sure that that information is accurate before you go in and get blindsided when you're confronted with that. Having money that you're willing to invest into the project and also collateral that you're willing to pledge towards the project, that makes you look attractive because it shows that you're personally committed to the success of this business.
For websites for grants, yes, the challenge with grants is they're changing so quickly. They might be only open for a few months and then maybe they never come back. Certainly during the pandemic, we saw lots of grant programs that were one time, they've never been repeated. They're not something that comes up every year and they're not perennially open. I can look up the website, but our one of our sister program, if you will, the Women's Business Center does have a grant guide, which is on CEI Maine, so CEIMAINE.org, and it is on our website, but we'll make a note and can include that link to that in our follow-up email.
Angel investors. An angel investor is usually an individual that is interested in entrepreneurial growth, and so they will have money that they're willing to invest in a business without taking an ownership position. They're being an angel, essentially. There in Maine, there's a group called the Maine Angels. Oftentimes they have a particular area of interest. So some of the ones that I've encountered in the past are really interested in tech development or research and development. They tend to be specific. And those opportunities, to be honest, are few and far between. And those require a business plan. You need to be able to pitch your business. But if you get the opportunity to do that, there's really, you know, it's very advantageous to you.
And to remember that angel investors aren't just some friend who's got a little bit of extra money in their cash and they're looking for a place to plop it. Angel investor is actually a very specific definition and term, and one has to qualify and be certified as an angel investor. It means they've got, I think last time I checked, it was like $1 million or more in net worth or $250,000 a year in income. So there's some really specific requirements to be an angel investor. That's not just anyone, and it is regulated. Oftentimes, as Chris pointed out, they're interested in things they know about. And oftentimes an angel investor will come into a company because they have background in, I don't know, breweries or something, and they can add experience and connections to that business to help it grow and scale quicker. But oftentimes what they want too is they're not doing it just because they need entertainment, but they're looking for a return on their investment. So oftentimes they're putting money in, they might take some ownership, but they're also looking at an exit strategy. They maybe put money in, but they're expecting you to sell the company in maybe 3 to 5 years to exit at a big price tag, hopefully, and they'll get their money back plus a bunch. So angel investors are very specific, but there are Maine angels And I think there might be even a Bangor Angels group. That's a subset of the Maine Angels, but they do have a website out there, their official group. Couple of things.
Collateral, we talked about home equity. And I mentioned that because it's the most common and it's often the most easily accessible. Other collateral could be, in some cases, it can be a vehicle that is otherwise unencumbered. So you can't pledge a vehicle that you still are making a payment on. But if you own a, $100,000 mobile motorhome, and there's no debt on it, they might consider that, or a vehicle. Retirement savings and life insurance, no. So retirement savings, think of that as those are invested in the stock market usually. And so their value can vary. So that isn't going to be an option. Cash is usually an investment. However, there are cases where cash can be held in an escrow account that the bank can control. And they can hold that. Sometimes they'll say, if you put in a certain amount of money and you make your payments on time for 2 years, we'll release that back to you. The other place, and this could be again another whole seminar, is the subordinate debt that we talked about, and those are usually nonprofit economic development, quasi-governmental government agencies. So that is going to be Eastern Maine Development, Androscoggin Valley Council of Governments, Southern Maine Finance Agency. There are a bunch of them, and they're usually by geographic region, and they usually have a mission that they're trying to fulfill. So it might be job creation in a certain area. And so if you can fit into those programs, a lot of times, even though you're getting a loan from them, the bank will look at that as your cash investment. So that would give you some equity in as well. You just want to be clear with your lender what their requirements are for that. And that's like we were saying in fit, make sure you fit with what they want.
And I will say, Chris, too, that speaking of retirement accounts, yes, some of us have money parked in a 401k or something like that. It is possible. I've had clients who considered or maybe did liquidate their 401k to fund their business. But again, I urge serious caution because it's very expensive money. I mean, first with a penalty because it was pre-tax money for those who pay attention to that kind of stuff, but it's really expensive money. And I'd just be cautious just to make sure you've got a plan and that there's not other alternatives for you. I don't think they can be used by banks as collateral because they can't sort of get to them. But just be cautious. And there's a special thing called ROBS. I've forgotten what ROBS means, but it's a way to take your 401k and use it for business purposes. But I think in almost 2 decades, I've only known about 2 cases that happened. So again, there would be huge tax implications. You'd want to have enough there. So it's possible, but not something we normally see. And I just see a question about, is it harder for LLCs to get investors? This is going to get really weedy, so I won't go too deep because it's a tax thing. Sometimes I've known of technology-based companies changing from an S Corp to a C Corp because of the tax implications for the way corporations are taxed. But again, that's something I've known for about 3 clients. But again, that's that special technology type of startup scalable business where they're truly looking for angel investors. It can make a difference, but you're going to certainly be looking for really specific and sophisticated tax counsel to take care of that. For most people, it doesn't matter if you're a sole proprietor or an LLC. The approach to finding funding will be the same.
Well, thank you all for your time today. I know we've run over, but we wanted to try to be as thorough as possible, but we appreciate your attendance. And we will make sure that you get a copy of the slide deck from today's presentation. And feel free to reach out to us. As we said, we have our email addresses and we're happy to answer questions.
Yeah, and as Chris said, just please reach out. I'm sure we covered some things. Maybe there's some things you don't want to put in the group chat, and I certainly respect that. Confidentiality is important to us. So feel free to reach out to us or to another advisor in your area, and we'll see what we can do to answer them. But thank you for coming. So I'm glad you're thinking prudently about searching for funding.
Have a great afternoon, everyone. Thank you.